A very warm welcome to IDFC First Bank presents Leaders of Tomorrow Season 11. I'm Ritvika Gupta. Tonight we are bringing you highlights from our Bengaluru Springboard, where we focused on how Bengaluru is galvanizing India's tech revolution. In the first segment, Anto Alan, Business Head, Business Banking, IDFC First Bank, spoke about Bangalore's tech prowess and the financial services offered by IDFC First Bank. In the second segment, Sunanda Jaiseelan spoke to Bharat Rathore Executive Director, Anand Rathi Private Wealth, Pradeep Sangunni, Executive Director, Client Associates, and Rahul Singh, Country Head, Private Banking at IDFC First Bank, about personal finances and effective wealth management. Listen in.
It's a great pleasure to invite this August audience to the Leaders of Tomorrow event in Bengaluru. It's always a pleasure to interact. We've been doing these events for quite a while now, and it's been great interacting with you. My name is Anto, like the way she had introduced. I take care of the SME lending business for IDFC. I've been doing this for about 2 decades in the SME lending space. Today we'll briefly talk about why Bengaluru on the tech space. I mean, it's become synonymous with tech now. And a little bit about ourselves and how we can partner in the ecosystem and what is the value addition we can deliver. And obviously post that we can network, and in case there are some specific things we can take up, more than happy to take it up. Why Bengaluru? I think on the tech space, Bengaluru has stamped its identity in it. In APAC, the second largest city in terms of technological concentration. In the world, the third largest number of technical startups and the fourth largest technological cluster in the entire world. Home to about a $200 billion industry, 1.5 million jobs. It's like every fifth person, I think, in Bengaluru is a techie. So that's the kind of concentration which is there. Also in emerging areas on AI, it's the fifth largest hub. The top 50 of NASSCOM's innovative, 1/3 belongs to Bangalore. Of the 1/3 of 7,700 odd tech startups which is there, 1/3 of it comes out of Bangalore. So that's the kind of vibrancy which is there in the city, in the tech space. So obviously when it comes to tech, this is the city to host an event and engage with people in the ecosystem. Before I can go to what we can do in terms of value adding in the ecosystem, I thought we'll dwell a little bit about ourselves, who we are. So as IDFC First Bank, we came into an existence in 2018. Prior to that, we were IDFC Bank, and then we had Capital First. This was a merger of two entities which happened. 2018 is when the merger got finalized. As IDFC Bank, we were a largely corporate banking entity. In fact, largely in the infrastructure space. That used to be our forte in terms of the banking space. And Capital First had built its capability in the retail lending space. And I think it was a marriage of two entities coming together. When we initially started in 2018, we had, as any startups would face, we are a startup bank that way. We had significant challenges in terms of what one calls as the CASA ratio for the bank, which is a measure of the liquidity and the low-cost funds accessibility. We are at about 10% when we started off. Today, I think we are one of the very few banks which has scaled up its CASA ratio in such a short span of time to reach about 50% of CASA ratio. Also, the first 3 years, we actually took a call not to grow the balance sheet. And if you had noticed our growth in the last 7 years or so, you will see the period from 2018 to 2021, we never grew the balance sheet. It's just that the composition of the balance sheet completely changed. We were largely a 70% corporate, 30% retail. And like the numbers would show, today we are completely reverse. We are like 70% retail and 30% corporate. And the last 2 years is when we actually, once we got this done, that is when we started growing the balance sheet. And now we are growing at about 30% consistently over a few quarters now, actually. So that was so while the overall balance sheet would have looked constant, there's been a lot of work which is going on in turning the entire color of the balance sheet. And that would have started reflecting on a net interest margins, which is the next measure we have in measuring any profitability of banks. So we are at about 2.5% kind of NIMs. Today we operate at anywhere close to 6.5% kind of NIMs. That's the kind of growth in NIMs which has contributed, which is an outcome of the fact that we changed the color of the balance sheet. So that's the kind of transformation which is going there, and we are on a path to build a truly digital first bank, which is guided by ethics, powered by technology, and for a social good. So that's the core mantra that we believe in. And obviously we are a startup bank, right? So we're a challenger bank in that sense. Therefore, a lot of industry first features that we came up with, some of it, for example, I'll talk about a little bit of it. Like for example, in the credit card space, we were the first ones to come with a dynamic APR, which the APR is linked, which is the interest rate that one pays on the rollover of a card. We start at anywhere between 9%. The industry norm used to be at 36%. We changed it linked to the CIBIL of the client, and therefore charge starts at 9%. So that was one. And there's a host of features there. We also started off on paying interest on a current account, where you have flexi deposits which can be created. Therefore, interest gets paid out on a current account. Like that, a host of features. In fact, every product that we launch, one of the first things that we go through a product, as any product, is that what is the customer first and what is the unique proposition there. And therefore, as a challenger bank comes out with a lot of such propositions, which benefits the customer. Like I said, we started off on a monthly interest. Normally, we are all used to a quarterly interest gets paid out on current account. We started with a monthly interest and pretty decent interest rates related to what the industry also pays. And like I said, we have something called a booster account, which we had launched, which pays interest on a current account. Funds about 2 lakhs gets transferred into an FD automatically, and then you start earning interest on it. On the card space, one of it was what I spoke about was in the dynamic APR. We've also given a host of other features. Like for example, typically when you withdraw cash from a credit card, and when you withdraw cash from an ATM, you're typically coached to say that, look, don't withdraw cash from an ATM because it's very expensive. The reason it's very expensive is because the APR starts from the time you withdraw cash, right? So for example, first of all, the APR is very high, and the APR starts from the time you withdraw cash. What we had said was, and what we given in the product was, if you are within your 45-day credit period that you have, then during that credit period, only the APR applies. Only you still enjoy that credit period, and then the APR applies after your credit period is over. So for example, if you withdraw money during your period, it gets charged like the way you swipe a card. So which means that you enjoy that interest-free period, and the interest starts only after the rollover period starts. And if you pay it off before the rollover period, then you don't get charged interest on it. So that's another feature we had. And we had no expiry on your reward points on your credit card. So typically, the way both reward points gets managed on a card, as well as the lifetime of a reward points, there's always limitation because reward points keep expiring, and then there are some limitations. You have to go to either a proprietary app, or you have to go, there are certain limitations in which how you can encash your reward points. There's one solution that I would like to speak in particular, and which is also receiving a lot of interest, is a structured solution desk that we have. In fact, we have formulated the desk especially for facilitating capital account transactions. We see a lot of startups raising money globally, and there's a lot of fund flow which is happening. We also see a global aspiration of startups who are also branching out. So which means that money coming in and money going out. Now, once you sign term sheets and get all the funding ready, the last thing that you want to get stuck upon on that your previous round SFGPR is not filed, therefore you don't get the permission to receive funds. That's the last thing that any startup founder would want to get locked in, because once you receive, once you kind of conclude your deal, you would want the money flow to happen. There is a set of regulations, there is a set of FEMA guidelines, there is a set of guidelines on capital raise, which if not navigated in the right manner, can lead to obstacles which you do not want to face. Therefore, we have the structured solution desk, which helps in structuring transactions depending upon what the need is. Either you're bringing in money or you're investing money abroad. What are the various mechanisms and what are the various regulations? It's a very specialized desk which helps you navigate through all the regulations, and we're seeing a great response to this as well. So that's in short about IDFC First Bank and what we would like to help and solve problems in this ecosystem. We are very happy and to take forward any further discussion that you have. Thank you so much for this opportunity. Thank you.
It's time for a quick break here. We'll be back shortly. Stay tuned. Welcome back. You're watching IDFC First Bank presents Leaders of Tomorrow Season 11, and today we are bringing you highlights from our Bengaluru Springboard. Listen in.
I'd like to ask everyone here on our panel today about your approach to wealth and finance. How did you get started? Just some personal insights, perhaps. And let me come to you first. Bharat.
Good evening, Sunanda. Good evening, ladies and gentlemen. So, I think my first tries with wealth started very early on with my career with ICICI Bank. And back in those days, you had something called Zurich Mutual Funds, which has now become HDFC, right? And back then, I was suggested by somebody to start investing on a monthly basis. With whatever meager salary, I mustered the courage to start investing with about 500 rupees a month in the Indian equity markets. And a year down the lane, I was fixated with the markets, and now for the last 20 years, I've been in the wealth industry, trying to make do the best that I can for our clients.
Thank you so much, and welcome again, Bharat. With that, let me come to you, Pradeep, and ask you to really talk about client associates just in brief and your approach to wealth.
So I started my journey in 2006 with Kotak, and then I built it along the way. 2019 is when client associates came into my life. So it's a multi-family office and a private banking firm. We started the firm in 2002. We've been 2 decades in the making. We managed close to $5 billion in wealth across multiple cities and as many in Tier 1 and Tier 2 cities. Yeah, that's about me. Happy to be here. Thanks.
Rahul, of course, is no stranger when it comes to the show. But Rahul, for anyone interested, perhaps a bit of a backstory.
So for me, it was an accident, in fact, lucky accident, I would say. In 99, after my college, Sundaram Finance came to our campus, and I was one of the 30 people. They selected across the country from my college, maybe 3 or 4. And then after the initial induction in Chennai, they, one of the rooms, they had multiple businesses. The primary being the lease finance business. So they were asking who wants to do what, and they were trying to assess. And there was only one role in a new company called Sundaram Newton Asset Management. Nobody had heard of that firm. So I don't know what happened, and I think there was only one position, and they said, any takers for Sundaram Newton? I just put my hand up, and the rest is history. So there, last 24 years, I'm in the same field. So I was lucky that I raised my hand that time, and it's really, so it was very, very, I didn't want to go into the traditional business. It was something which, was really exciting at that time. And then that's how it happened for me.
Thank you, Rahul, and welcome again. When I was talking about how many of the entrepreneurs in the room today are happy with the way the wealth is being managed, do they have, someone who's managing the wealth for them, etc. Only one hand went up. So I want to talk about financial literacy, and this question is to all three of you. For entrepreneurs, do you feel that perhaps there's that gap that still exists, and how can, and is there a simple answer solution in terms of how they should be approaching their wealth? What is holding them back? They're making the money. What's holding them back from perhaps being able to manage it better? Rahul, maybe you could take it first.
So I think one, this is this question gets asked quite often. I think we don't teach financial literacy in school. I think India may be one of the only few countries where we don't teach. So people, the kids don't learn the power of compounding, and even delaying your first investment by 5 years or 10 years can really have a big impact on your portfolio. So I think just that instead of starting at 35, instead of starting at 35, if you start at 25, and same amount of money you invest at 60, your corpus can be 3 times, So that massive difference just by starting 10 years early. So I think some of these things needs to be done early. And the second is, I think Indians were historically more invested because our financial markets were not very large and maybe well regulated. So more physical assets, which is which is not really very productive. So if you invest in land or buildings or gold, it doesn't go into the economy. But if you invest in financial instrument, which is bonds or equities, stocks, it flows back into the economy. So I think that is probably, these are two reasons I feel, the financial literacy is low.
Okay. Do you want to take that as well, Pradeep?
Yeah, so coming from a South Indian firm, you had your parents who park money in NSE certificates, and SBI was a bank you bank with. So that actually went into your genes also to be very safe with your capital. I think the previous session you heard about taking a risk. I think some part of your wealth should be in the Indian growth story, which is equity. The earlier the better. The compounding really works for you. That's one critical aspect, starting off early. And for SMEs here who have money idle, I think put that to use. People are not aware, you should really keep that money to work for you at some point of time. And I think take a slight risk. You've taken it to the business. I think taking it to the capital is not going to hurt you too much.
My question to you, Bharat, slightly different. The previous session we were talking about the use of technology and how technology really is changing the way businesses are being done. How does it apply to the way people are saving and investing? And are you seeing enough of technology really being used, and would you like to see more innovation perhaps when it comes to the world of the intersection between finance and tech?
There are two parts to this whole thing, The first part is to start with financial literacy and savings in itself. Now, a lot of people, we are not aware of inflation or what is the impact of inflation on our lives. We think 6%, 7% is the inflation, but what actually applies to our lives is a number which is far more higher. Take the cost of your children's school fees, on average 10, 15%. Our salaries sometimes don't grow at 10, 15%. Therefore, you got to get your money growing at a number which is double digit and beating inflation. So that's the first part in terms of literacy and saying, this is why I should do it. Again, like Rahul was saying, there's 650,000 crores of money which has been invested in India. Out of that, roughly about 3 lakh crores is in real estate alone. There's almost 2 lakhs in the form of fixed deposits. So there's a very small portion which is actually in the markets today, and therefore flowing back into the economy. Then the next part in this is the part of entrepreneurs investing. Like you have a business of your own, investing is like investing into another business. Investing into a simple equity mutual fund scheme is equivalent to investing into 70 businesses. What is the likelihood that on God's green earth you will have one day where all 70 companies have shut down? So that's the first part. Is there savings that has to happen, and is there more that can happen? There's a lot more that can happen. We're probably at 7-8%. Thanks to technology, the levels of literacy on this has improved. Thanks to technology, you have numerous platforms which are giving you multiple options of investing into the markets. You have companies which are giving you platforms where you can invest into stocks, you can invest into mutual funds, you can invest into peer-to-peer lending, and so on and so forth. But is there a long way to go? There's a really, really long way to go over there. And there's a lot of work.
I also want to talk very briefly about, the kind of volatility that we've been seeing of late in the markets, and how one should approach asset reallocation. For instance, if you feel that perhaps one asset is not doing well, what should you be doing? And in fact, maybe for those in the audience who may not be aware of why you should be looking at an asset reallocation, how often you should do it, how should you do it, just a brief 30, 40-second masterclass of sorts, if you can, and maybe I can come to you first, Pradeep.
So I think a critical part of this exercise is to monitor your risk to see how much of capital you can lose. And the best way to avoid that is to have an asset allocation in place. They say 90% plus of your return comes from a proper asset allocation that you run between equity and fixed income, which is your term deposits as such. Equity could be mutual funds or stocks. Clearly, it wouldn't be a right idea. Volatility is going to be a friend when you ride up, as well as when you go down, when you buy more. SIPs will really help to average that out as you go higher and as you go lower. Moving from one asset class to the other should be planned. It cannot be ad hoc because you have impact costs like taxes and loads that you have to look at before taking a call. We wouldn't suggest that you move from one place to the other. But if you have a plan in place, follow it to the last bit till your goal is achieved. And if you ever sell out of a particular asset, it should be for a requirement or a goal that you actually have in mind and not to plow back into markets again. So I think that's the safest way to play this game. Run an asset allocation, whatever is comfortable with you, whether it's 50-50, 70-30, and then run the game for 20-30 years. I think you'll be home safe. COVID, no COVID, I think you'll get your return.
On that note, thank you very much, gentlemen, for taking the time to
Thank you.
really talk to our audience about managing their wealth. Thank you so much. A round of applause for our wealth management experts. Thank you.
Thank you.
And that's a wrap on this episode of IDFC First Bank Presents Leaders of Tomorrow Season 11. We hope you enjoyed the episode. Thank you and goodbye.